Good morning. It's Thursday, June 27th, about 6 a.m. Central Time. Overnight, the precious metals are mixed after yesterday's sell-off. August gold held 2,300 with a low of 2304.90. I suspect that a significant amount of weakness in the copper and silver market stemmed from the expiration of the July futures contract. After watching thousands of traders over the past 23 years as a licensed commodity broker, what tends to happen is that a trader will hold on to a losing contract for the duration of the contract up to the expiration. They'll either not have the capital to roll over the position, become just frustrated, and just exit the future altogether. What this does is it lowers the open interest, it weakens the strength and the foundation of the underlying market that they're trading. You really want market participants. When it comes to futures, it's strength in numbers. That's why when you get a momentum trade, when all of a sudden the Wall Street bets, the Reddit crowd, the YOLO traders are coming into the silver market all at once, you get explosive moves. Or when the market tends to just base out and people come in here and they find the complacency due to the lack of volatility, it becomes a very strong foundation in the market. So what will end up happening, because I've seen this so many times, is since those traders had exited, when the market does begin to recover, those sideline traders become extremely frustrated. And what they do is they jump back into the market. That's why a lot of times, even on intraday trading, things like the NASDAQ, the S&P, or whatever market, you'll see the market just kind of hit a stop, some kind of psychological level, and then once it recovers back above there, the trader then who got stopped out re-enters the market trying to push prices higher. So that's a bit of trading psychology there. Now today we will see a barrage of economic data and a lot of economic data over the next 2 days. There's going to be reports on economic growth, you'll have the weekly employment claims. That's really what's going to be on every trader's radar ahead of the key inflation data tomorrow. So it's GDP, durable goods, and the trade balance. And then for GDP, we're expecting 1.4%. So we'll see how that number plays out. We have had weaker retail sales, slightly weaker consumer confidence, and it does roll over into the GDP figures. Now the claims are expected to be 236,000. That's going to be kind of an interesting one to watch, because if you look at a chart of claims, it's been going up here progressively over about the last 5 weeks. There's only been one downtick, but we are starting to probe some higher levels there. Now, something else that traders keep calling me about is the Japanese yen, and a lot of calls about the yen, which is weakened to 161 versus the dollar. We trade the inverse of it, so it shows at about 63 here on our chart. So the chart is actually the opposite on the futures contract. It just depends how you trade it, if you're looking at yen dollar or dollar yen. So either way, if you're going to do on a futures trade and you want a counter trend trade, you're going to be on the long side. Now this has reached the lowest level, the yen versus the dollar, since 1986. In order to reverse this trend, the Fed will need to have to cut rates, while the Bank of Japan will have to take some kind of policy stance in order to increase rates. This is because, and focus here for a second, institutions, financial institutions, they'll borrow yen at the lower interest rate. They then sell the yen and convert it to dollars, and what they do is they invest that at 5%, where our treasury yields are at, or about, or whatever, some higher yielding asset. So you need to discourage this type of behavior, and you need to reverse it. You need to make it less advantageous for these institutions to do this. Now, my suggestion is, because if you wait until the Fed does cut rates or the Bank of Japan makes a move, you're probably going to miss this trade. You'll all of a sudden hear about it. The Bank of Japan had intervened, or a big short covering trade had happened. So from a strategy standpoint, and this isn't a formal recommendation to the general investing public, if you want more information on how to play it from us, from our clientele, give me a buzz. But I'd really look at a calculated risk option, such as a call option on the futures or a call spread. If you go in on the futures contract, you might end up being the person who holds it for the duration of the contract, pukes out at the low, doesn't want to roll it over. So something similar to what we saw in the silver market, because June on silver historically is one of the weakest months throughout the year. Now, the next thing that you're going to want to watch here today, and try not to get triggered about it, is the debate. So you got to kind of put everything aside here and just focus on this thing as a commodities broker. I'll be wearing my Make Silver Great Again hat. That always triggers people out there. So, but the candidates being so far apart on their policies really opens the door for a wide range of volatility. The markets that I'll be watching when the debate is on, I'll have my quotes going on. I'll be watching metals, grains, and energies kind of as my top markets. I'm going to keep an ear out for discussions on China, on the trade balance, on tariffs with regards to China, on Iran, energy independence discussions, geopolitics, and then monetary and fiscal policy. Now, I don't really believe that these candidates are sophisticated enough in a sense to know from an economic standpoint how these things impact it. You're going to have to do some dissecting from what is being said out there in order to really take away on how it's going to impact these markets. Now, the best thing is that we've seen both of these candidates in office, so we do know that Trump had a very hard stance on China. It shifted agricultural purchases to South America. We also were very energy independent, so crude oil prices were a bit lower from here. So we're just going to want to keep an eye on the reactions to some of these different futures contracts. Now, looking at the technicals on the gold and silver market, 2300 critical level of support, I think, on the gold market. We held it last night. We'll see if we do briefly break below it. If you'll remember weeks ago, I told you that if you get a big update in the market, which we've had 3 or 4 of them, you want to look at having that longer term protection, something like a 2300, 2250 put spread. You have car insurance, you don't crash your car every day. Why not have some portfolio insurance just in case this thing wants to continue to break down? So looking at the silver market, it has converted to more of a neutral trend. We've been kind of going sideways to lower. We did have that $1.20 move up about last Thursday, a week ago, and then since then it's been a deterioration. You want to see the market recapture at least 2960. That's your 50-day moving average. Above there, you're gonna have to chew through a couple big days. It's that one big sell-off from back on like June 6th, and then also sell-off on last Friday. You need to get through 31.32 in order to spark a short covering wave to the upside. The YOLO traders will come back. DMI Plus will be back over minus, and stochastics will be rising from oversold territory. The line that you don't want to see is a close below 28.50. Chances are we'll end up retesting $28, and then it kind of goes into this where we kind of go into no man's land as far as critical levels of support. We did trade around a range of 27.50 for a while, and your 200-day moving average is 25.78. So that'll leave silver in the dust if we get down to those levels, and then we're going to have to look at longer-term strategies again. You got any questions, give me a call, 312-858-7303. Remember, futures option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.